I'm the fourth accountant, and today we are talking trading. Now, first things first, and let's limit my liability. Again, this content should not be construed as financial or investment advice. I am simply sharing my own personal opinions, which I hope will help give you the confidence to make your own financial decisions. If you need financial or investment advice, please seek in-person advice from a qualified, experienced, and regulated financial professional. Nobody on YouTube can save you. Now, let's get into it. Everybody wants more money, which is fair enough, and there is a lot of slop which promotes trading as a way to do this.
I started with $2,500 and was actually able to scale this close to $15,000. Then with a few big mistakes, I completely blew up that account. Luckily, fast forward to now, I'll sometimes have $10,000 to $20,000 trading profit weeks, and I'm grateful to now be able to manage over 7 figures of capital.
This full course will be packed with more value than everybody puts inside of their courses and sells to people for hundreds and sometimes even thousands of dollars.
In today's episode, I'm going to teach you how I was able to make over $1 million day trading in just 51 days. And I'm going to break this down into really simple, easy to understand steps.
But don't worry, you will obviously get your money back if you're not completely satisfied. Look, let's be real. Trading is simply a fucking waste of time.
Excuse me?
For most people. And we do not have to think too deeply to understand why this is the case for most people. To begin with, think about anyone you know personally that trades successfully. Generally speaking, the people I know have not taken a trading course.
Don't need it.
They simply educate themselves, have been trading for years, and always make losses. The traders I know emphasize the importance of risk management and psychology more so than simply learning the trading fundamentals. Much of this comes from experience, which is why successful traders tend to have been trading for a long time. To be clear, it is very possible that you can become a highly successful trader if you put your mind to it. You are not a statistic after all.
Shit! Alright, I tell you what. I'm gonna go with D, okay? But I'm getting sick of this shit, I really am. You know, they treat me like a dum-dum and a grunt, and I have potential, you know? I could go places, I could do things. Who knows? I might even rule the world one day.
Rule the world, huh? Yeah, if that happens, I'll blow myself.
But if it is something you are considering, it is worth asking yourself, why bother?
Excuse me?
And would your time be better spent doing something else that could still allow you to achieve your desired financial goals? Trading your own money and putting it at risk is not for the faint-hearted. Now, if you want to understand the fundamentals of trading, there is plenty of material out there which you do not have to pay for. Paying for trading courses is not a bad thing if you are happier learning in a more socially interactive environment. But simply understanding trading fundamentals will not, on its own, make you a successful trader. Firstly, trading and investing are not the same thing. Typically, when you buy or invest in an asset, you do so because you want to own it. This is because investing in an asset provides additional economic benefit or income streams. Trading, typically, is more speculative in nature. The trader does not necessarily intend to own the asset. Instead, the trader usually just wants to profit from the change in asset price. This distinction is important to understand because you do not have to own an asset if you want to trade it. Secondly, investing and trading is centered around contracts. Check out my video on what the fuck is an asset, which explains why the existence of assets requires contracts. However, trading contracts have different features compared to investing contracts. When you invest in stocks or shares, for example, you own the stock or share. It's basically that simple.
Yoink! Hey!
But when trading, typically you are not interested in owning the stock because this ties up your cash or capital. You just want to profit from any increase or decrease in the stock price. So, one method is to enter into a contract with someone else, typically a brokerage, that commits you to sell stock to them at today's price in the future. If the stock price drops, then you can purchase the stock and then immediately sell it at a profit. This is an example of short selling or shorting, and it is a way traders can profit from the falling price of an asset. Conversely, a trader may go long if they wish to benefit from the increase in asset price. A trader can use a CFD or contract for difference to either go short or long without having to buy the asset. Crypto traders can use a contract type called perpetuals to trade crypto assets in a similar way. These types of trading contracts are generally referred to as derivatives. There are many types of derivatives, but in simple terms, they are just contracts that typically derive their value from the price movement of an underlying asset. i.e., if you enter into a short contract to sell an asset, then to you, the short contract will be more valuable if the price of the asset goes down, but less valuable if the price of the asset goes up. The opposite will be true for the person you entered into the contract with, because they have adopted a long position to buy the underlying asset. These concepts are also important to understand. Trading involves winners and losers. No new wealth is being created. Additionally, entering into a trading contract involves fees, some of which are dependent on the difference between the initial price of the asset when you entered into the trading contract and the closing price in the future. This difference is also called the spread. What I have outlined simply scratches the surface of trading fundamentals. The point is simply to appreciate that trading is more complicated than investing, and it is very easy to make mistakes. This will lead us onto the next aspect of trading, risk management. Trading will always involve losses, unless you have insider information, which of course you shouldn't. To put this into perspective, just consider the number of free trading apps on the market. If they are free, how do you think they are making their money? Well, if they have a CFD offering, it is possible they expect most traders using their platform to lose money. Even the most experienced traders lose money. After all, no one can predict the future. However, many of them will be experienced enough to adopt strategies that limit their losses and maximize the return on their winning trades, so that overall, a lot more money is made than lost. Another point to consider is that experienced traders do not necessarily make lots of trades. They can simply make one or two massive trades, meaning they only have to be right once. If you follow Gary's economics, this is something he talks about when describing his own views on the wider economy and how it influences his trading decisions. The Big Short and the GameStop saga are examples of big trading bets paying off based on an underlying theory. But this approach is a double-edged sword. If you are wrong, you are fucked. Now, I know what you might be thinking. If I enter into a trading contract and I am wrong, I can simply choose not to close my position by buying or selling the asset until my trade moves to a favorable position. Well, this is correct, but the contract requires that you must buy or sell the asset eventually, and there are mechanisms in place to ensure that this is what happens, one way or another. Firstly, as I mentioned previously, trading contracts do not involve owning the asset. As such, you are essentially borrowing assets and putting some money in as collateral, which is usually referred to as the margin. For example, if you wish to make a trade of $10,000, you may only need to pay $1,000. This means the $1,000 is the margin, and the trade has a leverage ratio of 10 to 1. So, Any profit or loss on your $1,000 trade will be multiplied by 10. Because assets are being borrowed or leveraged to enable the trade, there will be financing fees, there will be other brokerage fees, and fees related to the daily spread of the asset price. The point is that to keep the trade open involves ongoing fees. You must have sufficient finance to maintain an open trading position if you believe it will eventually pay off. Again, check out The Big Short, which illustrates this point really well. Secondly, many trades will require negative balance protection. This usually automatically closes all your open trades if your trading account balance does not have enough funds to cover the losses of your open trades. So, even if your trading theory is correct, it is possible you are still automatically stopped or closed out of winning open trading contracts because of regulatory safeguards.
It only happened to me once. I was only once ever in the red, which was in my second full year as a trader in 2010. So I was 23. I'd put a big bet on, which had some risk to Swiss interest rates. And the Swiss central bank suddenly cut rates to negative 4.5% for some crazy reason. Specifically using the product that I was betting on. I lost $8 million in a week. The maddest thing about it was the right bet. If I was allowed to keep that position, I would have made it all back. But I wasn't allowed to keep that position. So you end up $4 million in the red and you have to fight your way out of it.
Because trading involves borrowing or leveraging, it comes with a huge amount of risk. Short selling in particular is extremely risky because, theoretically, the size of potential losses is unlimited. I will say that again. The size of the potential losses is unlimited. This is because there is no theoretical upper limit of the price of an asset you are committed to sell. This theory is central to many retail investors continuing to buy shares in GameStop, and why at one point in 2008, Volkswagen became the most valuable stock in the world.
10 years after Occupy Wall Street, there's a new type of financial protest. But instead of marches in Zuccotti Park, these protesters are sounding off on social media sites, calling for stock tips that will make the group rich while hurting hedge funds on the other side of the trade. Their meeting place? A subreddit group with more than 3 million members known as Wall Street Bets. It was there that the idea of buying GameStop went viral. As the stock soared, the financial world was left stunned.
We are seeing a phenomenon that I have never seen.
There's nothing normal about what you're seeing when it comes to this stock right now.
That's because GameStop, which sells video games and consoles, is not doing well. Their sales are plummeting, and their stores are shuttering. Most analysts say profitability is still years away. So why did the Reddit group buy? Well, it started this spring when a user pointed out that GameStop had a massive amount of short interest, bets essentially that the stock would decline. As long as the stock fell, short sellers would make money. But the Redditors figured out that if they collectively bought a bunch of GameStop, they could force a surge. The short sellers would have to buy back higher, creating what's known as a squeeze. And it worked. GameStop skyrocketed, going from $3 in April to nearly $350 today. Several large hedge funds were severely wounded in the process.
It's Germany, isn't it, Linda?
Yes, it is. 8.7 is where we're at the moment, but we gained nearly 11% at one point this morning. And again, it's all down to Volkswagen. What is going on here is unbelievable. The share, it nearly doubled this morning. It reached a level of 1,005 euros, and already yesterday, the car maker rose 147%, causing the DAX to stay in positive territory when the rest of Europe was declining. What is really going on here is very hard to say. It must be the worst case scenario short squeeze one can in fact imagine, and it's all about Porsche saying over the weekend that they hold 42.6% in Volkswagen currently, and another 31.5% via options. So indirectly, Porsche holds nearly 75%. The federal state of Lower Saxony, they hold another 20.2%, so just over 20%. So effectively, there's only a tiny free float left of just under 6%, 5.7%. And if everybody is short in a share with such tiny free float, If those two things come together, then that can cause these severe disruptions that we're seeing again today. Or as one analyst, he put it, each and every short seller in the world is trying to close up their positions, and there's no way they can do it except for trying to buy like mad. So it's panic among investors. Many had bet on VW's share price to fall. So the share's recent move, it's all down to covering of short positions rather than any fundamentals, because they don't look as good as you might suggest when looking at the share price. And that is having also a severe effect on the other members of the DAX, such as the India index heavyweights, Allianz, Siemens, E.ON, because index tracking funds, they're selling the 29 other companies listed in DAX to catch up with Volkswagen, and it's a big embarrassment, in fact, for the German market.
Another point to consider when it comes to short selling is that many people who do this successfully forensically investigate the company, senior management, open legal cases, and company finances, for example. As such, they have a high level of insight and knowledge, which gives them the confidence to predict a catastrophic drop in the company's stock price. They will then enter into a short contract and then release their findings to the wider public, actively driving the stock price down. Now, to be clear, this is not price manipulation and it is not illegal. Equally, it is not guaranteed to work. The point is that short sellers are adopting a strategy that increases the chances of their trade being successful. The trade is not based on blind speculation, and equally, many successful traders are not blindly speculating. Otherwise, going long is not as financially risky as going short, because at worst, the lowest price an asset you are committed to buy will be zero. If you do not understand anything I've said, then trading is probably not for you yet. Anyway, to manage the risk of trading losses, traders will use one of several types of stop loss orders or instructions available to them. Well, because no one can consistently and reliably time the market. So, knowing the right stop loss order to use and when to prevent accidentally closing what will eventually be a winning trade requires skill, experience, and judgment. Also, trading requires active monitoring of positions during trading hours, which is impractical if you have a day job, for example, and access to real-time trading data, which you normally have to pay for. Trading positions, especially crypto trading positions, can change rapidly, which in some cases can make it difficult to profit from a change in asset price if the price is moving very quickly. This is why mastery of risk management and the use of stop loss orders, for example, is critical to trading success. When it comes to trading, there are simply no shortcuts and no hacks. Even if you are using trading bots and automatic stop loss orders, you must still be able to actively manage your trading portfolio at all times during trading hours. Now, let's think about the third aspect of trading I mentioned, the psychology. Trading is not for everyone. Some people are simply not built for it.
Hold on a minute. I have potential, you know? I can go places, I can do things.
This is not a criticism, but it is simply very difficult to trade objectively and rationally when it comes to your own money. Trading or investing can cause anxiety, obsession, depression, or addiction, and you are already ahead of the game if you can recognize this in yourself. There are always other ways to achieve your financial goals. But it is also important to accept that risk and opportunity are two sides of the same coin. Otherwise, many trading theories assume traders are rational, selfish individuals that do not collude or cooperate. This is simply not true. Clearly, individuals collude and are happy to share the wealth.
Fallout on Capitol Hill as Democrats are making allegations that some folks within the president's inner circle may have had a heads up that this tariff walkback was coming. Starts with this Truth Social post where the president tells everyone it's a great time to buy, and fueled by this video posted by a White House staffer last night from inside the Oval.
This is Charles Schwab. It's not just a company, it's actually an individual. And he made $2.5 billion today, and he made $900 million.
Nancy Pelosi's comments, though, from the former director of the U.S. Office of Government Ethics. And I want to see if we can pull that one up, because he says specifically, it's a ridiculous comment. She might as well have said, let them eat cake. Sure, it's a free market economy, but your average schmuck doesn't get confidential briefings from government experts chock full of non-public information directly related to the price of stocks. And that really is the key in terms of the concerns that have been raised. It's that a lot of lawmakers have access to material information that aren't necessarily available to the general public that allows them to trade a little more with insight. And the question is whether, in fact, they should be allowed to hold individual stocks.
Even professional traders are people, and people struggle to consistently make rational and objective decisions, whether they relate to trading or not. Many experienced traders I know commonly tell me about the psychological battle they have with themselves when trying to make objective trading decisions. I mean, it's easy to imagine how you might feel if you enter into a short position, but the price of the asset immediately and dramatically increases.
Oh.
There would be a pressure to simply cut your losses so that you can live to fight another day, even if your trading theory is actually correct. However, an experienced trading professional may see the same scenario and choose to double down because there is an opportunity to make even more money if the price eventually drops, or place another trade in the opposite direction, commonly referred to as a hedge, as a way to manage risk. Also, if your overall trading position is a loss, it would be understandable if this clouds your judgments on future trades. Even if you make a winning trade, it will not be immediately obvious why it was successful if you are just starting out. And again, this can lead to false confidence clouding your trading judgment going forward. The point is, people tend to place importance or meaning on past events when considering the likelihood of what might happen in the future. And in many cases, what has happened in the past has no bearing on what may happen in the future. And if you are a great trader, people or bots can quickly replicate your trading strategies, limiting your potential returns. As such, staying ahead of the curve and understanding the sentiment of your chosen trading sector is a full-time gig, which makes sense only if you already have a natural interest and passion for that sector. So, is trading a waste of time? Well, generally, yes. Statistically, most traders will lose money, and beginners should not immediately start with more complicated trading contracts like CFDs or perpetuals. But if you really want to become a trader, I would say go for it. It is still a waste of time for most people, but I suspect they are probably trading for the wrong reasons. At worst, trading teaches you a lot about yourself and will improve your financial literacy and confidence, which will improve your general investing decisions and your ability to build wealth that way. At best, well, you never know, you might just end up ruling the world.